Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to cover the basics of how a line of credit works. Just do a comparison of the different types of lines of credit and also compare how a line of credit is different from a loan. So a lot of people think when they first learn about velocity banking that they don't have access to the tools to do velocity banking. But I would say that's actually not true because a credit card is a tool, it's the line of credit that one of the types of lines of credit you can use to engage in velocity banking. And looking at this article, it seems like the average American does have access to a credit card. They just use it irresponsibly, but over $1 trillion of debt, according to Reuters. Now, so let's just do a quick review of what a line of credit is. Basically, a line of credit is a financial tool where you can borrow money, pay it back, and then reuse what you've borrowed. So that's what a credit card is. Even though the term credit card doesn't have exactly the term line of credit within it, it is a type of line of credit. So that's what we mean by revolving. When we say that if we take out the money, we pay it back, we can reuse it over and over again. So that's the basic, most powerful feature of the line of credit. And if you compare a line of credit to a loan product, and it's kind of based on the same thing that you're borrowing, kind of like almost like apples to apples. Like, so for example, let's say I'm borrowing money for a line of credit to purchase a house. I think they call it a purchase line of credit or maybe a home equity line of credit, where it's based on a house compared to a mortgage. The line of credit is pretty much always going to have a higher interest rate unless you're an introductory zero period. But just be aware that a line of credit may have an interest rate that's like 10 to 15%, whereas maybe that loan would be at like 2 to 6% usually, based on your credit profile and circumstances. Okay, so a line of credit, how is that different from a loan? So loan is usually just a fixed payment structure where the bank lends you a certain amount of money. I understand that there's some variable rates type products, but we're just going to go with the average product where let's say they loan you X amount of money, you have to pay back maybe, $300 a month for 10 years. Well, I think that's how, your average student loan or auto loan, or maybe an auto loan is a little different where you pay like $600 for 6 years, but usually it's a fixed payment structure and the interest rate is lower. And the banks understand that it's okay for them to put a lower interest rate on the loan because there's no revolving feature. If I overpay the loan, I can never get that money back, right? And they know that, and that's why they say, okay, well, with this loan, well, maybe that might encourage people. I'm just thinking on behalf of them. I don't know what they exactly think, but they might think, hey, okay, we know that most people will never overpay a loan, hence we'll put the lower interest rate. But once they pay back everything, then we're going to get a much higher interest rate than we could potentially get from maybe a credit card. Now, here's the thing. If people just have balances on the credit cards and they never pay them off, they're going to make a lot of money on that too. So don't think that somehow not paying off your lines of credit is this magical thing where you can have a higher interest rate and win, right? The idea is that if you watch the velocity banking videos, the line of credit is a tool that you're going to use in order to pay off the loans quickly, even though it has a higher interest rate, right? So what's quote revolutionary about the velocity banking strategy isn't the tools that are available because the tools have always been there, right? It's like if I go to Home Depot and see all these tools available, yeah, they've been there for a long time, but what might be like a new insight for me is to learn how to use the tools. I know if I go to Home Depot like and I buy a bunch of tools, they're just going to be sitting in my garage because I have no training on how to use them. It's the same thing with velocity banking. You probably have access to the tools. You just need to know how to use them. Okay. So let's just do a simple comparison between all the different types of lines of credit, any sort of peculiarities or things to highlight. So the first and foremost type of line of credit is the personal or business line of credit. So basically, the bank says, okay, you can borrow up to $15,000, and it's usually unsecured, right? Meaning that it's not tied to anything that they can take away as collateral, like a house. Sometimes they might have a secured product, means that if you pay $5,000, they'll give you a $5,000 line of credit, and if you don't pay it back, then they'll just keep your $5,000. So that's what it means by a secured line of credit. But usually it's unsecured. And the only difference between, let's say, a personal uh, line of credit versus a business line of credit is that personal is tied to you, your name, whereas a business is tied to a business you may be operating that you would use for business expenses only. Okay. So as I said before, again, it's usually a higher interest rate. I have a personal line of credit for about 15 grand. And I noticed that the interest rate is usually about 14 to 15. It may vary at a daily rate. So maybe one day it could be 14, another day is 15. But just be aware that it's a higher interest rate and it's really flexible. So for example, let's say I have a $15,000 balance available and I just need to pull out $10 from that line of credit. All I have to do is just go to the bank's website, say I want $10 into my checking or savings account, and they'll allow me to easily do that, right? So that's what's great about the both personal, business, and home equity line of credit. So just be aware there's some nuances between a line of credit versus a credit card. And that's what I'm going to go over in the next line. But so now if you have access to a home and your home has equity, you can get a home equity line of credit. So it's basically secured to your house. Normally it's what we call second position. So the mortgage is first position, meaning that if you don't pay off, let's say the mortgage, they have the right to foreclose on you. And then if you don't pay back the home equity line of credit, they would have the right to foreclose on you too. But the first position lien, that's what they call it, and I'm not going to go too much into this, has to be paid back first, then the second position lien. So it's kind of interesting how that works. But usually it's tied to your house, and the whoever is putting that lien has the right to foreclose if you don't pay back the home equity line of credit, whoever it is issuing it. But because it's usually, so here's a rule, like rule of thumb. If something is secured by one of your assets or whatever you have, your collateral, you're going to get a lower interest rate and higher limits. That's like a normal rule of thumb. So with my personal line of credit, I got about $15,000 limit. And when I got a home equity line of credit, I got a $50,000 limit or somewhere around there, and the interest rate is a little bit lower. So this would be like 14 to 15, the personal line, whereas the home equity line would be about, I don't know, 10%. Now, in my experience, home equity lines of credit also have great introductory rates. So maybe for 6 months to a year, they give you maybe like a 1.99% interest rate or even zero. So that's pretty ridiculous. And I would take advantage of that if you know that you have a lot of debt that's at a higher interest rate, and transfer it there and try to pay it off as soon as possible. Now, last type of line of credit is the credit card. So a personal credit card is just something that's tied to your name. A business credit card is something that to be tied to your business and you would only use for business expenses. So usually unsecured, but it could be secured. You would just have to make maybe probably cash as collateral. Say, hey, I give you $5,000. Give me a $5,000 secured credit card, and if you don't pay back, they just take the $5,000 away from you and just keep it. All right, and usually it's a higher interest rate than a business or personal line of credit. So it's not uncommon for credit cards to be at a 30% interest rate compared to the 15% business line of credit. And there's some restrictions on how you can use them. So for example, I put that you can't pay a credit card with another credit card, right? They don't allow you to do that. But what's cool with the personal business line or home equity lines of credit is that if I take out money from there, I can pay back anything. I can even pay back the line of credit where I took it from. So for example, let's say I took out $10 from the line of credit today, and then I paid it back the same day or tomorrow, like, they don't care in my experience. They might charge even a little bit of interest just to take that money out, but I can still pay it back using the exact same tool. Whereas with the credit card, I can never pay back another credit card with a credit card, and I can't pay back a loan directly. So I've used Velocity Banking using a credit card because I was interested in using, Plastiq, which is an online payment tool where you can pay certain loans or loans with certain credit cards. So I use the Discover to pay back a home loan. I think I did a $5,000 chunk on a home loan. So there's some nuances of how it's different. Another thing that I would say is a plus for a credit card is that you don't immediately get charged interest. There's like a floating period. So if you pay back the money immediately with the credit card or within, I think, the full balance for every statement, you're usually not going to be charged interest. Whereas with the business or personal or home equity line of credit, the moment that you take away or withdraw some money, they immediately charge interest. So you might do a combination of like credit cards and lines of credit. So maybe you make your purchases on a credit card so that you could take advantage of the floating period of where they don't charge any interest. And then if you have any other debt and you're using Velocity Banking and you're using lines of credit to pay off your other debts, then at the last moment possible, you would transfer the line of credit to pay off your credit, maybe your one credit card you're using to make your general purchases. Okay, so now let's compare this to a loan. So most loans, I think, are very similar. So I put all you do is, as I said, you have an average length of time you pay the loan for probably a fixed payment. Again, there might be some differences based on your financial situation, the type of loan that you've taken out. But for the most part, it's going to be a fixed payment. So I put in some averages here. They might not be accurate to your situation, but nowadays the average loan, auto loan, is about 6 years, and people are paying $700 a month for a new car in 2023. Right? It's crazy. I remember when I got a car for $400 a month in like 20, I don't know, 14 or 15. And people were criticizing me back then. They're like, whoa, $400 a month. And then now the world's gone insane and people are paying $700 a month for a car loan. But you pay it off in 6 years. Now, same with student loans. It's the same thing. You pay for about 10 to 20 years, and the average monthly payment is about 300, 400. And home mortgage, I'd say average length, technically people are supposed to pay in 30 years, but the average length is probably over 30 years. And the average monthly payment is 1,500 and 3,000. Again, with the home loan, because there's so many different types of homes, the situation, especially with regards to average monthly payment, will be different. But just be aware that there's going to be a certain length, a certain fixed payment structure, and then once that payment's over, you can never re-borrow the money again. One thing I kind of want to emphasize is that every payment that you have, especially on a loan, is kind of like a decrease in your cash flow. So the way that I interpret this, whenever I see an auto loan, is, or whenever I see this and say it like I have an auto loan, is okay, for 6 years, I can never have $700 available to me, right? Same thing with the student loan. So if for 10 to 20 years, I can never have $300, $400 available to me. And same with the home loan. So for over 30 years, $15 to $3,000 is not available to me for me to use for whatever. So it's eating up our cash flow. And that's the whole point of Velocity Banking, is that yes, you're using some of these tools. And if you want to see more examples or more in depth, go to Velocity Banking 101. But basically, and I'll put that as a link to in the description to the previous video for that. But my point is that you can have a combination of both. So you don't want to ever have the mentality that, hey, loans are bad, I'm never going to get a loan, and I'm going to put everything on line of credit, right? Loans can be good, right? So for example, if I have a home loan where the monthly payment is low compared to the debt amount, and it has a lower interest rate, I'm actually at a better position if I use a smaller limit line of credit to pay off the loan. And I go over that in Velocity Banking 102. But just be aware, don't be in that mindset where it's like one thing is completely bad and one thing is completely good. These are all just tools that the bank has. And what's, quote, revolutionary, as I said before, is the way that we implement how these financial tools are used rather than the tool itself. I think people get way too caught up on the tool itself rather than how we use the tools. Okay. All right. So great. So I hope that this has been helpful to you all regarding the differences between the line of credit. If you're interested in any sort of mentorship and would like to join our group, give us a shout out. Feel to send us, an email. If you go to the about page of the channel, just email us, and then we'll give you some ways to join our group, whether it's online or in person. And then another thing I want to mention is that you can also fill out the Google form link, which I'm going to paste on the description below. So you just tell us a little bit about yourself, and then we'll give you, we'll set up a time to contact you on Zoom, and then we'll see if you're a good fit for the group. All right. Have a great day, everybody, and then we'll speak next time.